Welcome to today's report, the June 20th. Okay. Now the news events. Today, the report is about the Fed's June 2025 pause, dollar firms, market divided, and all eyes on September. Right. So the FOMC committee left its benchmark rate unchanged at the June 17 to 18, 2025 meeting, holding the target range at 4.25% to 4.5%, and reaffirmed its projection of 2 quarter-point rate cuts in 2025, unchanged from its March outlook. Now, in addition, policymakers marked up their 2025 inflation projections to 3% and core PCE 3.1% from 2.7% prior. They also trimmed expected GDP growth to 1.4 from 1.7%. Now, in effect, the Fed signals it still foresees a half-point rate reduction next year, even as price pressures run above targets and growth slows. Importantly, the dot plot revealed sharper divisions on the path ahead. 7 of 19 Fed officials now favor no rate cuts in 2025, up from 4 in March, while 10 officials still pencil in at least 2. Now, this split underscores a narrow majority for easing and highlights policymakers' uncertainty, right? So, the chair, Jerome Powell, cautioned against placing too much weight on the 2025 rate path, emphasizing that incoming data and inflation dynamics will drive decisions, especially given what he termed a meaningful inflation risk from new imports. Now, in the post-meeting press conference, Powell noted that if not for impending tariff-driven price increases, rate cuts might actually be in order. But with a potential cost shock looming, the Feds prefer to wait a couple of months to gauge the inflation pass-through before easing. Now, this balanced approach of recognizing higher short-term inflation while keeping the door open for future rate cuts paved the way for a more measured and mixed market response. So for the US dollar outlook, it's stable for now, vulnerable later. So why do I say that? In the short term, the dollar remains supported by relatively high US yields and global rate differentials. With Fed delaying cuts and other central banks like the ECB expected to ease soon, the US dollar is holding firm. The dollar index rose modestly following the Fed's meeting. However, the medium-term picture leans bearish. Once the Fed begins its easing cycle, which is most likely by September or Q4, and if inflation continues to trend lower, the dollar may weaken. The dollar index could drop further if US rates fall and growth slows further, especially if Trump's tariff hurt exports and widen the fiscal deficit. Okay, so that's the key point over here. See how tariffs, the dollar's movement will hinge on the outcome of the tariffs. As for the stock market reaction, markets welcome the Fed's maintain rate cut projection, but enthusiasm faded by market close. S&P ended flat and the Nasdaq gave up early gains, reflecting investors' concern about a divided Fed sentiment and potential rising inflation. Valuations remain stretched, especially in tech. Without clearer signals that inflation is falling and cuts are imminent, US equities may trade sideways in the short term. However, any signs of a confirmed Fed pivot could fuel a late year rally, especially in rate-sensitive sectors. Then the next part, I think is an important one, is the quantitative tightening, to see whether, what's the progress on it, and what about QE, the drug that the stock market needs. Okay, so QT slows quietly and QE unlikely without crisis. That's the point right over here. The Fed continues its quantitative tightening program. but at a minimal pace of only 5 billion per month, a sharp drop from previous levels. While this isn't QE, many see it as a quiet winding down of QT. Okay? Powell didn't say when the Fed might completely cut its balance sheet reductions, but past years' events in 2019 and 2020 shows that the Fed can act fast to pump money back into the system if the financial markets run into troubles or money becomes harder to access. While there's no sign of QE is imminent, a severe downturn of financial market stress could prompt the Fed to resume asset purchases. For now, the Fed seems content letting QE fade into the background. Okay, so when will cuts begin? Market bets on September. Markets are pricing in a 70% chance of the first rate cut in September, with 2 cuts by end of the year in line with the Fed's dot plot. But 3 main factors could shift this timeline. Number one, tariff-driven inflation. Powell warned that import tariffs is still working through supply chains and could lift inflation over summer. If this bump is temporary, a September cut remains on track. If not, the Fed may delay. Number two, labor market softness. The Fed's forecast unemployment to rise to 4.5% by year end, currently 4.2. If job losses mount quickly, the Fed could act sooner, but as long as labor markets remain solid, Powell said Fed can afford to wait. Number three, inflation expectations. If core inflation shows signs of a steady decline towards 2%, the Fed will gain confidence to cut. If inflation surprises to the upside, the Fed will likely hold off. Okay? So, what about history? Right? Now, this cycle resembles late 2018 when the Fed paused rate hikes amid inflation and growth concerns, then slowly began cutting in 2019. It also reveals reveals a reversal of 2021. Okay, when the Fed delayed hiking as inflation rose and later regretted it. So, learning from that mistake, Powell now prefers to delay easing until inflation is clearly under control. Even that risk slows growth. Okay, investors should expect patience, not urgency from the Fed. So, as a conclusion, I would say a divided Fed equals a divided market. The Fed's June decision reinforced a cautious, data-dependent stance for now. The dollar stays strong and equities stay in wait mode. Whether the Fed cuts in September or later will depend on how tariffs, inflation, and labor data evolve in the coming months. Investors should brace for volatility and prepare for multiple scenarios, with September's FOMC meeting likely to be the next major turning point, provided that whatever it is still stays status quo, and we shall see. Okay, but definitely the market is looking for certainty. A divided Fed is not something the market would enjoy. Okay, because it will show introduce very much uncertainty right here. Okay, so with that, that's the report for today. Now it's charting time.